we want to see how the double entry system interacts with the accounts. Here you have a very simple table. In this table are shown the main accounts that we can find in the accounting discipline: the assets, expenses, liability, revenue, and equity. Now, as you can see, when it comes to assets and expenses, if we debit the assets or the expenses, they will increase, and if we credit them, they will actually decrease. The opposite principle applies to liability, revenue, and equity. If we debit them, they will decrease, and then if we use the credit side, they will increase. Let me show you a few transactions so that you will get it, and this is a very simple exercise that I'm doing together with you so that you can really understand how this whole thing works. Let's say that we receive $100 from our customers. Now, this means that our cash account increased. Now, the cash account is an asset, therefore we want to increase our cash account by $100. But keep in mind that the transaction is not balanced yet, because the first thing that we want to do now, the other thing that we want to do now, is to record our revenue by $100, and we want to increase our revenue. Therefore, we go on and we credit the revenues. And that's how we balanced the first transaction. Let's see now the second transaction. Let's say that we spent $100 in supplies. This means that we actually want to increase our expenses by $100, and on the other hand, it means that we actually spent this money in cash. And if we did so, it means that our bank account is going to decrease. Therefore, we want to go on and decrease our bank account by $100, and that's how we balanced our second transaction. Let's see now a third example. We borrowed $100 from the bank, so this is a liability. But when we borrow money from the bank, our liability increases because we're gonna have a future obligation or future money to pay back to the bank. So the first thing that we want to do is to increase our liability by $100. But what happened here? Well, if we went to the bank and we asked for $100, for sure this $100 is gonna go first to our cash account before we buy anything, or we can use it directly to buy something, and if we do so, this something is gonna be classified as an asset. That's why we want to go on and increase our asset account by $100, and that's how we actually balance our third transaction. Let's see another example. We earned $100 from the customers. This example is very similar to the first one, but now this is the reverse. So when we earned this money from the customers, we want to increase our revenues by $100, and then of course we want to increase our cash account by $100. Let's see now the last example of this lecture. Let's say that we put $100 into the business. Now, if we do so, this $100 is going to be considered and classified as equity. Remember that the equity is the money that we put into the business to get future or to share the profits that the company is going to generate in the future. The first thing that we want to do is actually to increase our equity account by $100. But as you already know, this is not good enough. We are missing a second step here. When you put money into the business, again, this money can be used either to buy some assets, and if you do so, it means that your assets will in any way increase, and that's what you do. You record the $100 under assets here, and that's how you balanced your transaction.